Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Dan Boardman-Weston, Chief Executive Officer at BRI Wealth Management. Thank you for joining me again, Dan.
Thanks for having me on, Kimberley.
And you have been on this podcast before, but for those who may not have listened to that episode, which I say go back and listen to it, can you give us a bit of background into yourself and your experience in the industry?
Yeah, sure. So I joined the industry in 2011, straight from school after doing my A-levels. I did plan on having a gap year, but I found finance and my love for it has continued since. So I've been with BRI since then, mainly on an investment sort of focused path. I then left the firm in 2017 to do an MBA at Warwick Business School, really to broaden my skill set and help me come back and sort of grow the business in the future. So I rejoined the firm in 2018, took up the position of Chief Investment Officer, and then moved to the position of Chief Exec in 2022. And then since then, the firm's been growing pretty well, and we've got some quite ambitious plans for the future. So no, it's quite an exciting time for me personally, and also for the business as well. So yeah, that's a little bit about me in 32 seconds or so.
That was amazing, very concise. But we're here to talk about the world, I guess, and how that pertains to investments as well. So obviously a couple weeks ago, the tech world seemed to have lost its mind a little bit after DeepSeek came out. So it was dominating conversations, especially in AI investing. So what was the driving excitement? And is this still a thing? Are people still excited? And why do you believe it won't last?
Yeah, I think people got quite unsettled, I think it's fair to say, by the DeepSeek announcement, really because I think the consensus thinking was that AI clearly is going to change the world and is changing the world, but it's going to be sort of large language models that cost lots and lots of money to sort of do, and there's going to be lots of power and lots of sort of other things. And then having some sort of maybe it's not the best way of putting it, but some Chinese sort of startup come and say, oh, we can do what you do, but for sort of cheaper. a lot less money. And it really flustered the markets quite somewhat. Markets have settled since then. And a lot of the companies such as Nvidia that fell quite sharply over a couple of days because of that announcement have broadly rallied to where they were beforehand. I think with the DeepSeek announcement, there was a lot more sort of detail behind the scenes. And I think people over the last couple of weeks have clearly reappraised the whole AI trade and probably come to the conclusion that, yes, it still is a valid trade and a valid place for people to be invested. And maybe what DeepSeek were saying was not quite as people had read it when it initially came out. I think for us, I mean, our portfolios have, good exposure to beneficiaries of the artificial intelligence theme, and it is changing the world as we speak. It is making companies more efficient. It's impacting all of our lives, and that will continue to be the case over the coming years. I think where we have a slight issue is the valuations around some of the big mega cap artificial intelligence names, whether that's Nvidia or a couple of other of the Mag 7. The trend is sound, and AI is going to continue to change the world, but valuation is ultimately what drives long-term returns in the stock market, or the price you pay for an investment. And when you're buying these companies on some pretty punchy multiples, you've got to make some pretty punchy assumptions on future growth rates. And I don't think anyone really fully understands how this is going to play out in the coming years. And so whilst we're very much positive on the theme and have exposure to it, we are slightly cautious about some of the valuations that these companies are trading on. But I think what's pleasing to see after the DeepSeek announcement is that the Chinese equity market has got a bit more life in it, which is good. Clearly, we all know about the political risks and economic risks with China, but the stock market has been very undervalued for a number of years now. So we've seen a bit of a boost there. So look, it was a bit of a shock to investors. They seem to have got over it. AI is still a place that people should have money invested, but I think it's just about managing those exposures and not having all your eggs in one basket.
Yeah. And I assume, do you foresee that this kind of thing will happen again where another company comes in and shakes the table?
I think it's the nature of innovation. You do have upstarts that come in and innovate and sort of evolve and change the dynamic that maybe we've all become used to. So yes, do I think the winners of the AI race that we've seen over the last couple of years, again, it's those Mag 7 names, will necessarily be the winners of the future? I think some of them might be, but I think we'll probably be talking about a different set of companies in a year or two than what we're talking about now. So yeah, I think it's likely to be different companies that will benefit from this trend. And as I say, it really just comes down to the valuation side of things. Nvidia's a $3 trillion and change dollar company. For the share price to double from here, it's going to be a $6 trillion company. I mean, you've got to make some pretty punchy assumptions on revenue growth, profitability growth, to make that stack up over a long-term time horizon. And so, definitely hold some exposure to these companies, but it's not a place to be putting all of your assets.
Okay. And for advisors who speak to their clients, who their clients will see these headlines and see these short term and think, oh my God, my investments are in the wrong place. We need to, what advice would you give to those people who are having to deal with those clients that are seeing, those things and might have more of a short term focus?
It's tough, because the right call over the last few years has just been to bung everything in an S&P or NASDAQ tracker and forget about it. And that's done wonderfully well. But investing is a long-term game. And I think the market has and people can have short-term time horizons when it comes to investing. This has done this over the last 6 months. Why hasn't my portfolio or these investments done the same? And ultimately, what determines your long-term return is the price you pay for an asset. And so, a lot of the conversations that we have, and I suspect other advisors are having in the industry, is that, look, yeah, things have been pretty good, but we've not got all of your eggs in this technology and Mag 7 basket, even though it's done well, because valuations are pretty high, and actually you do need a diversified portfolio over the long term. I mean, we've had some pretty exceptional growth in the American stock market and American assets, but if you look based on historical data at buying the stock market at the aggregate level, at the valuation it's at now, typically based on data going back sort of 100 years or so, future returns are pretty paltry at this level. Sort of maybe a couple of % a year looking forward 10 years or so. And that for me is quite a powerful graph and a powerful statistic. And it feeds into that price. It's the price that you pay for an asset that determines the long-term returns. And I think Microsoft is a good example. And I can't remember the figures, so I'll make them up slightly. But Microsoft has done wonderfully well since the year 2000. Revenues have gone up exponentially, this, that, and the other. But the share price of Microsoft got ahead of itself up until the year 2000. And then it took 16 years for investors, if they'd bought in 2000, to actually make a profit. The business continued to perform exceptionally well during that period, but the share price had got ahead of itself. So it took 16 years. And so I think it's very easy to get caught up in the hype of the latest sort of hot trend or the hot company, but you do have to remember that this is a long-term game, and as I say, valuation is key.
Right. And looking at the UK economy, it's remained sluggish, and Europe faces increasing economic and political turbulence. So where can investors find stability and opportunity in this landscape?
Yeah, I mean, there's a new headline every day, and
every day.
I thought the world was fast moving sort of beforehand, but really heading into 2025, there's something new to grapple with each day.
Yeah.
I think clearly with what's going on in Ukraine and the negotiations around that, and sort of Trump coming into office and changing the geopolitical landscape and I suppose the norms of the way of doing things, is that it's quite an uncertain world. What I would say is that Europe has got certain political issues which, we'll deal with this year, sort of whether it's the German elections or other things that are going on. But I do think European stock markets look pretty attractive with the current valuations, even though they've done relatively well this year, even sort of taking into account the threat of tariffs from Trump. But I think the UK, and I bang on about this a lot, but it's because I really believe in it. I mean, the UK stock market is just very cheap. And actually, the UK since 2016 has been through a pretty turbulent period from a political perspective and from an economic perspective. But whether you agree with the Labour government and what they're doing or not, at least we've got some political stability for the coming years. And I think you're starting to see this play out in markets. I mean, the FTSE 100 has done pretty well this year compared to other markets. And I think investors are increasingly nervous about the American markets, political risk that sort of Trump poses, and sort of what's he going to do, valuation risk, as we've sort of just talked about. And I think people are looking elsewhere and realizing that actually there's a big old world outside of the US, and actually the UK, some pretty good companies here, looks pretty cheap, we'll have some of that. Europe, some pretty good companies, global companies, pretty cheap, we'll have some of that. Emerging markets. And so, yeah, I think it's that diversification piece that is key. And I think a lot of people have had a lot of money in America for a number of years, and actually now banking some profits and redistributing that into places that maybe have less political risk and less valuation risk seems to be what a lot of investors are thinking about.
Okay. And with interest rates potentially staying higher for longer, how should UK investors be positioning their portfolios for long-term resilience?
Yeah, I mean, it's a global theme that rates have stayed longer than we all expected. I mean, it was clearly a big shock sort of through 2022, 2023, when they went from nothing to 4.5%. And there's a whole generation of people that just hadn't been used to, I was not used to interest rates being anything apart from basically nothing. And so it's been a big adjustment. I think from a market perspective, it's quite normal over the long term for interest rates to be 2, 3, 4, 5%. And I think investors have started to adjust to that. Where we're quite positive at the moment is some of those rate-sensitive areas that have really been hit and hurt over the last years, whether that's property or infrastructure or some cyclical sort of names as well, where the future value of those cash flows is less because interest rates have gone higher. But actually, there's some still pretty positive structural themes. So things, we invest in a number of investment trusts in the UK, whether that's commercial property or infrastructure. And actually, some of these trusts are trading on discounts of 20 to 30%, which is pretty attractive, buying them at a discount to the net asset value, especially when private equity is buying them or increasingly trying to take over assets at a premium to net asset value. And you're buying these things on sort of 7 or 8% dividend yields, which is, 3.5% premium above the 10-year government bond yield. That feels like a pretty good place to be. And actually, you don't need to make aggressive assumptions if you're getting a 7% dividend yield to make some pretty good returns over the next 10 years. So I think that's one area we're positive on. I think mid and small cap companies generally have been pretty poor. American small cap companies did pretty well once Trump got elected, just because that sort of general sort of reshoring and sort of US economy being a little bit more insular, which made sense. But UK and European smaller companies haven't really benefited over the last couple of years, and they're trading on very attractive valuations. Small companies grow quicker than larger companies. It's just maths, and they're trading on valuations that are similar to larger companies at the moment. And so again, as rates start to decrease and there's a little bit less pressure from a balance sheet and an economic perspective, we think mid and small cap companies across the globe will do well as well.
Right. And you've mentioned Trump a couple times.
How could I not?
He seems to have such a big impact, especially in the investment world. So which sectors or assets do you think could benefit the most from this transatlantic shift?
So, I do think smaller companies, especially in America, will potentially benefit from Trump being in power for those reasons that I say about tariffs and sort of geopolitical risks and tensions. But the short and honest answer, Kimberley, is I don't know, because the political landscape is changing by the day. And it's not like Trump's come in with, necessarily with a mandate of I'm going to do X, Y, and Z, and we've got certainty about what he's going to do. Things just seem to be changing all of the time. And so I think it's very difficult to ascertain what will necessarily be the beneficiaries of a Trump presidency over the coming years. I think it does come back to, for political, economic, and valuation reasons, having a diversified portfolio. And having a diversified portfolio has not been beneficial over the last 10 years. Go and buy the S&P 500, go and buy the NASDAQ 100. That has been wonderful. And anyone who's done that, absolutely fair play. You've called it spot on. But looking forward to the next 10 years with where we sit today, with political and valuation and economic risk, do we think that's going to perform as well as it has over the last 10 years? I would wager quite a lot of money that it's not going to. And again, it's that diversification piece that I think is key.
Yeah. And going back to the tariffs that you mentioned, do you think those tariffs and trade policies could create opportunities or pose risks for especially UK investors?
I think it will be interesting to see whether the UK gets some sort of sweetheart deal with Trump, which is clearly what Starmer is trying to do. And Starmer's trying to sort of play that bridge between Europe and Trump at the moment from a Ukraine perspective and sort of building on that special relationship. So if the UK isn't hit with tariffs or not to the same extent as other countries in Europe or across the globe, then yes, I think there will be the UK stock market will probably do pretty well under that scenario. But I think there's a number of sectors and areas that have been impacted by the prospect of Trump's tariffs, whether it's automakers or manufacturers or there's lots of different sectors. And some of those with current valuations look pretty appealing, but that element of political risk is still a bit of an overhang. And so I think you want exposure to these areas in a measured way, but it comes back to we just do not know what Trump is going to do when he's going to do it. And so again, and it's probably you probably call the podcast this sort of diversification by Dan Boardman-Weston, but it just comes back to that diversification piece. We live in such an uncertain world, a world that is changing by the day from an innovation perspective, from a political perspective. It's tricky to make really sort of punchy calls on you need to be invested here in a big way, because things could just change overnight.
Right. I understand that you just said that, but I am going to ask you what your outlook is for UK equities. Are they undervalued, or are there deeper structural issues at play?
Well, I'm conscious of your time, Kimberley, because I could talk about this for hours. They're undervalued is the short answer, and also there are deeper structural issues at play. The UK market, especially at that top end, FTSE 100, is wonderfully global and diverse. 70% of revenues are generated overseas. It is a global market. And you've got companies in the UK that are trading, take oil and gas companies, BP, Shell, whatever it is, that are trading on 20, 30% discounts to American oil and gas companies that do broadly the same thing. That's wrong and that's inefficient. And I firmly believe that will get arbitraged and arbitraged away, and that will change over the coming years. So there's a lot of value in the UK market, and especially in the mid and small cap end, as I mentioned earlier. I think the structural thing is very interesting for UK markets, and this is what I spend a lot of time thinking about, not necessarily from a work perspective. I just think it's quite interesting. We've got, an awful lot of pension money in the UK that has moved away from allocating to UK equities over the last 20 or 30 years and allocates overseas. Most wealth managers or IFAs, go back 20, 30 years, most of your portfolio would be in the UK, and it's allocated overseas now. And you've sort of got this sort of death spiral. Sounds a bit extreme, but you've got fewer and fewer people allocating fewer and fewer pounds to the UK market, and that depresses valuation. And when you added in over the last sort of 8 years the political risk and the economic risk and all of that, it's been pretty miserable for people. And then when you look at sort of listing rules, which granted have changed over the last sort of year or so, but it's difficult and expensive and onerous to list in the UK market, the general global theme of companies wanting to stay private longer, it's meant that there's a number of key structural headwinds that have depressed UK asset prices. And so I do think the UK is fundamentally undervalued at pretty much all market capitalization levels of the stock market. But I struggle to see what will meaningfully change this over the coming years, because you've seen a big uptick in mergers and acquisition activity in the UK market over the last year or so. And really it's sort of trade or private equity buyers picking the good stuff off the market. We'll pay a 30% premium for that, 40%, we'll have that. It's good business, quite cheap, lovely. And we're not having the primary issuance, we're not having the initial public offerings that we need. And if they are coming, potentially they're not of the quality that we would like. And so there is part of me that fears that the UK market will continue to have the good companies taken private, and it will either not have companies coming public or good companies coming public, and it leads it to become sort of a bit of a backwater, sort of poorer quality companies, and something that's not interesting. So it's a very interesting debate, and one that's very live at the moment. And I know the government is trying to encourage and improve the stock market, and change settlement periods, and attract companies to list on the UK market. But it's difficult to see at the moment the UK being in a really strong position from a stock market perspective. I think what you will see over the coming years is some of that valuation gap close, though, because companies are just too cheap. I don't think it will go to where it needs to from a long-term valuation perspective, but I think companies generally are very cheap at the moment, and I think they'll move to a position of being cheap or fairly priced, if that makes sense.
Yeah. And lastly, looking ahead, you've already mentioned diversification, but I wondered what other core investment principles should guide UK advisors amid today's challenges.
I think the industry has changed a lot since I first entered it in 2011, and I think it's changed broadly for the better. But I think a lot of what drives things at the moment is past performance and costs. Mm-hmm. And look, we're in a privileged position. We are stewards of people's capital. People worked hard all of their life, and they want money to be able to retire on and sort of live the lives they want. And so I feel very fortunate that we're in a position to help them along that journey. And so things like costs are very important. And past performance can be important when making investment decisions. But for me, it feels like we've moved a little bit too far that way. Because if you were an advisor now, it would be very easy to recommend a portfolio that was largely American equities because it's done really well over the last 10 years. So, that looks good. That looks good for the client. And it's probably quite cheap because you're probably going to allocate to passive funds. So that's great. It's cheap for the client. And that is a good thing. Super. But as I say, looking forward 10 years, do we think the investments that have done so well over the last 10 years will necessarily be the investments that do so well over the next 10 years? And no, I don't. And so I think for me, it's that diversification piece. It's that long-term thinking. We're investing for the majority of our clients for decades to come, and actually maybe taking a slightly less dogmatic approach when it comes to underlying costs, and recognizing that there's value in other areas of the stock market, and recognizing that in certain areas, having active asset management makes sense. Mm-hmm. Arguably, being active in America, some people do a good job of it, but actually just bung it into a passive. Lovely. It's done well, probably do well in the future. But other areas, whether it's emerging markets or small cap equities or more thematic equities, so things like healthcare, which we're very positive on, mm-hmm. I firmly believe you need to pay up for that and you need active asset management. But I worry that the industry is moving and has moved too cost conscious and too passive, and that more and more people have more and more of their eggs in the same basket, and that might not lead to the best outcomes for our clients, the general public and consumers, mm-hmm. moving forward. So I think really it's sort of stepping back and having that long-term approach to investment, being able to guide clients through the inevitable ups and downs, and making sure that you don't have everything in one particular market or one particular sector.
Yeah. Well, that was all very good advice. Thank you again, Dan, for joining me on this podcast. It was really interesting to talk to you again, and I hope we can do it again in the future.
Yeah, no, looking forward to it, Kimberley.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine, so make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.